So welcome to this 14th, actually, Finance Watch public conference. We're still there, we're growing. And it's interesting because the 13 first events were actually only indirectly related to the motto we were created with in 2011, which is making finance serve society, which is now today the main question. So how do we align the financial sector with societal goals? And of course, we're very happy this is happening. But indeed, our reading is that we would have hoped this discussion would have started earlier, and we think while the G20 focused on how do we make finance not hurt society, we think it could have been quite a different discussion if the purpose of finance, which we are discussing today, was put at the forefront. It's a bit like trying to, if you want to avoid that coastal villages get hurt by a tsunami, the only chance you got really is to avoid the tsunami from happening. Otherwise, that's going to be very difficult. And we believe that is still a bit the case with the financial system. And the good news there is that you can actually prevent these crises to happen, but you need to look in depth at the issue of this financial system, which is still too big to fail. And we think there's still more to do on that. So I think the first element of sustainable finance is that it should be stable. Financial instability, as we all know, is a key impediment to the long-term investments that we need. Now, as I said, we are absolutely delighted that the Commission kicked off the work of the high-level expert group, and will follow up early next year with a communication. We've been following the work of the HLEG and studying carefully the interim reports. We've done that in partnership with our members and other partners, Share Action, SOMO, Friends of the Earth, Global Witness, WWF, many others. We've looked at green bond standards, fiduciary duty, disclosure, but also the key element of the S and the G in ESG, and making sure there's not an excessive focus on the first part. Now, we've released today a blueprint, which is our specific approach to this issue. And this is also reflected in the program you've seen, where we do think it's quite key, as I said, going back to the G20 agenda, that finance is a servant in this process rather than a master. So you will see in our approach, we do think it should start, although it seems obvious, with an economic vision for the EU and a path towards a zero carbon economy in the EU, how we get there with specific milestones. Then you need to make sure the incentives are right in the economy, and reflecting that to kick off this transition. After that, we do think public finances in many different ways, and in general, mission-oriented finance, governments, public banks, the whole range of stakeholder banks are quite key, because for these actors, sustainable finance is not a risk or an opportunity, it's actually their key focus. So we think a strong direction should come from that. And then indeed, but only then, you need to look at the full range of instruments available within financial regulation to align the financial sector to these objectives. We are absolutely delighted that Mr. Olivier Guersent will open the day and share his views about the future agenda of the Commission on this key issue. We'll have a keynote speech from Jean-Pascal Vanni-Purcell, which is quite expert in this area of moving to a zero carbon economy. I really want to thank all the distinguished panelists who will follow in the three different panels. So the first one will look at getting a sustainable economy off the ground, so looking at the incentives in the real economy. Then we'll have a short break, and I'll ask you to be disciplined because we have a packed agenda this morning. Then the second panel will look at a just transition, and so the opportunities for jobs and communities as part of this agenda. And finally, we'll have a key discussion on the high-level expert group and the follow-up. We're lucky again to have a Commission representative and also two members of the European Parliament to look at the policy agenda in the coming months. Apologies from James Vacara, who was supposed to moderate the last panel. So he'll be replaced by Greg Ford, Finance Watch staff, to moderate the last session, and then hopefully you'll join us for a networking lunch. I will now call Mr. Guersent to share his views and the Commission's views on how to take the work of the high-level expert group forward. Thank you. Enjoy the conference.
Oh, great. Hello, everybody. It's always a pleasure to be here at Finance Watch because I'm quite proud to be, if not a founding father, founding fathers were in the European Parliament, but one of those that participate to the creation of Finance Watch. I think it's quite unique that an institution like the Commission has to organize and finance its own counter lobbying, and I think that tells a lot about how finance is organized in Europe and in the world more generally. So it's always a pleasure to be here at Finance Watch, even if I do not always agree with Financial's view. I would quite strongly disagree on some occasions. But we need a healthy debate on financial issues, and for this we need centers of expertise that are not necessarily financed by the big market players in the financial industry. I'd like to thank you for this invitation today. It's a very important topic. It's a topic that is very dear to the heart to my heart, but more importantly to the heart of President Juncker. There will be a limitation on what I'm going to be able to tell you about the future today, and that is that Mr. Juncker is speaking at the One Planet Summit next week, where I think he intends to say what we are going to do. And I don't want to be sacked because I would have revealed it today, so I'll be relatively vague. But still, I think it will be interesting. You said, Benoît, we have launched the high-level expert group on sustainable finance. At the same time, we launched Capital Market Union, actually. And it's not completely by chance. There is a strong link between the two. We need to develop capital finance in Europe. We need to rebalance our system. We need to have more equity financing. And we need also to redirect our savings to more long-term and sustainable uses. And all this makes a very congruent policy in our view. But it's also clear that it's not sufficient. I mean, in order to get sustainable development to take off, in order to reach our COP21 goal, we will need to have a deep re-engineering of the financial system. Investments have to become more sustainable. They have to become more long-term. And that's the only way the financial system will be able to play its part in promoting development. And we will not be able to bring the EU economy in line with the COP21 goals if we are not able to mobilize finance and capital markets. So the first reason why we should do it is, of course, for the common good. But if some are not convinced by the common good, this is also a business opportunity. I mean, you said it's not, we should, well, I think, especially in finance industry, people are not completely insensitive to the concept of profit. So if you do not do it because you think it's good for the planet, at least do it because it's probably good for the European financial industry. We are at a point in time where the US, at least at institutional level, is disengaging. The Asian region, under the leadership of China, is going very, very fast in the area of sustainability because it's a big issue for them. It's a tangible issue. I've seen that last week already there was a big conference in Singapore in order to promote the first Asian green labels. And this is a race. And, you know, I remember 20 years ago, I was involved in the GSM standard saga. And the reason why we derived a competitive advantage in mobile telephony for 15 years was that we were the standard setters. We will derive the same advantages if we are the standard setters in the area of sustainability. For this, we need to move fast because others are moving fast as well. So if you don't do it because you think it's good, do it because it is profitable. On our side, as you know, we are a non-profit organization. So we are rather motivated by the common good. And that's the reason why we are trying to develop an overarching EU strategy on sustainable finance. We think it is absolutely key that we reform, in that sense, the EU financial policy framework, and I will come to this in a moment, in order to allow for a better alignment in Europe of capital flows with sustainable investments. At the moment in Europe, we have a general mismatch in terms of timelines. We have we have more savings than we ever had, but these savings have a huge appetite for short term, let alone sustainability. And what is certain is that not all long-term investments are sustainable, but all sustainable investments have a long-term dimension. So we need to rebalance this, and this is why there is such a high relationship between Capital Market Union and our sustainable finance agenda. You said, Benoît, that we have created the high-level group on sustainable finance. That's true. I want to say here, I know a number of members are here and will be intervening today. I had very high expectations when we set up that group, and that's the reason why I insisted that my friend Christian Thiemann share it. But they have exceeded my expectations. I mean, the work that has been done by this group under the leadership of Christian is just amazing. Those of you that have read their interim reports can testify it, and we are meeting this afternoon and tomorrow in order to finalize the final report, and the final report will be even better. So the work that is being done here has no equivalent in the world, and I think that that should be underlined. So I've just alluded to the interim report. The interim report was published on 13th of July this year. It was followed by a big conference here in Brussels. And for me, the first value of this interim report is that it identifies the challenges very clearly. And if I may sum up, I would say probably a number of key barriers to the development of sustainable finance in Europe. First, and I just alluded to it, the mismatch between the short-term horizon of financial actors and the long-term needs of a sustainable economy. Second, an approach to financial risk management that does not fully integrate material sustainability risk. Best example, I mean, I'm French. If I think about EDF or French electricity company, stranded asset, the way they're accounted for is not satisfactory. Third, a financial system which has become more stable, you said it, but it is not yet fully connected to the real economy, and in particular not to the needs for a transition to a low-carbon economy and a resource-efficient system. So what I mean to say is that the work, and I take fully my responsibility because I was at the heart of the engine for the last almost 10 years now in trying to redo the financial framework in Europe. I think we did a relatively good job. I think we're in a safer place than we were. But at the same time, we were very busy restoring financial stability, I would say more than promoting sustainability. So maybe we should have done it earlier, but and maybe we could have done it all integrated, but that's probably was above the limit, at least of my capacity to integrate too many dimensions of a single problem. So, but the truth is, the sectoral toolkit that we have put forward is fine, but is not yet fit for sustainability. It lacks common definition. It lacks common metrics. It lacks the means to give the right incentives to market participants for them to invest in a more sustainable and long-term way. So the group offered that mapping of the challenges, but it also offered core areas of work and priority areas of work in order for the Commission to shape its agenda. Firstly, and most importantly, and this is probably the first challenge we are going to tackle, the need for a common language. You need to, if you want to promote sustainability, you need to know what is sustainable. If you want to promote green, you need to know what is green. Otherwise, you will have, the inventivity of the financial sector is limitless. So I can tell you, if it is economically profitable to invest in green and sustainable, and you don't have a proper definition, everything is going to be green and sustainable. And this is exactly what we should avoid, because nothing will change. So it is absolutely essential that we know what we're talking about. And that's why the first challenge that was identified by the group was the need for a comprehensive and rigorous taxonomy. That's a very big challenge. I mean, colleagues in the EIB have started to do that work on carbon content. That's challenging enough, but carbon content doesn't subsume the issue of sustainability. Circular economy, biodiversity. You have a number of areas in which you need to defend what is sustainable, what is not. Climate is, of course, very important. This is where the work is most advanced. This is probably where we will start with, but there is a lot of other things to do if you want to move really to sustainable finance. Once you have the taxonomy, you can build on it. You can develop standards, you can develop labels, you can develop benchmarks, indexes. And this is not for the Commission to do, probably. This is for the private sector. This is for a joint effort between the two. We need to think about the governance of this whole system. Still too early to say, but we need to have a system that provides the solid basis to know what we're talking about, what we want to promote, what we don't want to promote, in order to enhance confidence and trust from the investors and the consumers, so that they can help funding the transition to a more sustainable economy. The second thing we need to do, we need to better integrate ESG factors. And I agree with you, the E is extremely important, but the S and the G are equally important for me. We need to better integrate them across the investment chain. We need to embed sustainability in the investment mandates of asset managers as well as institutional investors. And thirdly, we need to ensure the systematic consideration of sustainability across EU financial services legislation and ensure consistent application throughout our single market. So, if you think about it, I mean, the core areas of work identified, which I just spelled out, in the interim reports offer already a work program for years for the Commission and its partners. And more is to come in the final report. That's the reason why we have responded to 3 of the 8 recommendations in the interim report already, because there is no time to lose. On the 20th of September, the Commission has adopted what we call the ESA review, which is the review that was foreseen of the 3 European supervisory agencies, created at the beginning of the crisis as the first response following the rapport by Jacques de la Rosière. And in this ESA review, we have followed up one of the key recommendations of the group, which is to provide the ESAs with a mandate to take into account ESG factors when they carry out their tasks. They were lacking the legal basis to do this. Once the ESA review will have been adopted by the co-legislators, they will have it. On the 13th of November, so very recently, we have launched a public consultation on asset managers and institutional investors' duties regarding sustainability. And that is clearly responding to the problem identified by the group, that we need to ensure systematic consideration of sustainability across the chain. In reality, what we need to do, and what I would like us to do, is that we mainstream sustainability in financial regulation. I think that's the appropriate way to do it. I think if anything less than this will be missing the goal. And on the 21 September, Eurostat has published an updated guidance on the recording of energy performance contracts that makes it more interesting to finance such contracts and use them, as it clarifies the circumstances in which these contracts can be recorded off government balance sheet and therefore off Maastricht Treaty criteria. So it moves fast. It will need to move bigger and faster in the future. It is clear that despite these initiatives, more and a lot more needs to be done to bind together these existing elements in the area of sustainable finance. So we, of course, understand, I just referred to it, the importance of a common taxonomy for sustainability. It's absolutely essential. We need to start there because this is the basis on which the ecosystem can develop. And we intend to do so. We're also reflecting, but back to this first point, it creates a number of issues of governance. Should it be a public body? Should it be the Commission? Should it be a private body? Should it be a public-private partnership? How do you ensure a taxonomy needs to be able to evolve relatively smoothly and fluidly? That's not the European system. I mean, if each time you need to modify it, I need to draft a level 2 legislative act that will be submitted for veto, 3 months non-opposition period extendable by the Parliament and the Council, I think it's going to be difficult. So we need to think a bit out of the box. We need to find the right governance that ensures the credibility, the rigor, but at the same time, the flexibility in operation. We need to be able to move fast at the pace of markets. We're also reflecting on how to enhance transparency. It's all good and fine to have all this, but if nobody knows, if the investors do not have access to the information in a proper, transparent, and comparable way, most of these efforts will be useless. So transparency and disclosure are extremely important elements if we want to develop an ecosystem in the field of sustainability. We, of course, need to base all this on robust, scientific, and forward-looking metrics. So there is a lot of work to be done in a very short time, and no time is to be lost. Let me go on by simply giving you an overview of what's next in terms of process. So the group, as I said, is meeting today and tomorrow. They plan to finalize their work in January. Once this will be done, the Commission will study very carefully the final report, although we have already a good idea of what is in it. It is, for a large part, already finalized. And we will follow up by an action plan. This action plan should come very quickly. It should be, as I said, ambitious, and it should provide for clear deliverable in a clear timetable. We would then intend to launch that action plan here in Brussels with a big conference in the spring. So that's the way it is going to be done. Now, what are going to be the first deliverables is something you will have to wait for next week. President Juncker and Vice President Dombrovskis to announce in the One Planet Summit in Paris. But I hope you will not be disappointed. Thank you very much.
Yes, I'm very interested in the new accounting rules regarding energy performance contracting. I'm representing Housing Europe, so we are representing all the non-speculative housing providers in Europe, the municipal, social, public. So this is extremely interesting for us. But in many cases, these are not directly government units, yet they are investing heavily in energy efficiency. And I wonder, is the current move, has it gone far enough? Because I think it's limited only to government units.
Well, that's the only part that is not in my kingdom. So, but normally, ESTAT rules are valid for, I mean, that's what governments complain a lot about, is even non-government units, what they do is computed in your debt and in your deficit. So my understanding is that that's valid for everything that meet that requirement and falls in this category. But your question gives me the opportunity to say that there is a lot you can do also through private financing. I mean, I'm quite interested, for example, about what Aviva is doing at the moment, the UK, where they finance huge energy renovation programs on a market base. And it's simply because through the savings you can make on fuel with energy efficiency renovation of buildings, you almost can finance the renovation along the term. So you need an investor to take that risk on his shoulders, and typically insurers would do that because they have a very, very long balance sheet, and they have an interest in having very long-term projects with long-term yields, not necessarily huge, but very stable. And this is exactly the definition of this type of investment. So depending on what's the price of fossil fuel, it makes more or less sense. I know that German economists had the idea, which I think is excellent, to couple this with a tax measure. So because if you would define a floor price for the ton gas, for example, at which a number of projects make sense without subsidies, well then when the price falls below, the tax kicks in to maintain the price for customers at the floor, and you may use the product of this tax to subsidize investments in energy renovation that would not be profitable at the floor price, but slightly below. So that's a quite interesting idea to match the market finance mechanism for energy renovation, energy efficiency renovation, together with some form of public subsidy, but that is smart, of course, because it's based on this floor price concept. So these are the type of things that could be done. Of course, the problem is as soon as you talk about tax in Europe, you're in a huge mess. But I think member states could be well inspired to think about this, because that would enhance the capacity of long-term investors to carry this type of projects.
Two more questions? Well, one here and then one there, and then I think we'll have to let Mr. Guersent go. Yeah.
Yeah, just a quick comment. You said that you were working on stability and later on now on sustainability, and that the other way around could have been better. But stability is part of sustainability. I'm just repeating my way now. Without financial stability, there is no long-term investment. So you should include it in your taxonomy to work on financial stability. And even the German government has included stability in their sustainability strategy.
I agree with you. Although for methodological purposes, if you want to make sure you're effective, you may have an interest to segment things. I mean, a lot of people are smarter than I am, but I have a limit in the number of things I can jungle with at the same time in terms of concepts. What I was meaning to say was simply that between 2010 and 2015, we were trying to put out the fire in the house. And by doing this, and we did the first repair to make sure the house doesn't fall and is pretty stable. Of course, we could have done, we could have thought at this time, oh, yeah, well, that's good, but as we are doing it, maybe we can make it energy positive. And the only thing I said is that we were not good enough in doing this, so we have now to do it because the regulatory framework that we have been putting forward was doing a relatively good job, in my view, in restoring financial stability, but could have been better in integrating sustainability concepts, which is what we're trying to do now. For example, the idea to have investor fiduciary duties in the field of sustainability is something we could have done before as we were renovating the framework. We didn't, so we do it now.
Thank you. There's a last question in the back. Thank you.
Yes, thank you very much for the presentation, Margaret Wachenfeld from Themis Research. I'm here. Thank you. There's clearly been a lot of work on the E, and I was very pleased to hear you also talk about the S and the G. And clearly the S is an area where Europe is a leader in the world, and yet that leadership in the S area doesn't seem to have been very well connected yet into this agenda. Can you just say a little bit about what you're planning to do on the S and the G, if you have concrete plans? Thank you.
Yeah, well, the G, I think, is in a way easier than the S, of course. We have been carrying out a lot of work on governance and will continue. And of course, it's difficult to, if you don't have the right governance, it is unlikely you will reach the right result. The most challenging part is the S, because everybody says it's great, social is very important. But the truth is that, for example, as far as the European Commission is concerned, the legal basis for the Commission to act in the social field is relatively weak. My legal basis is, for example, stronger. And that means social is still today in Europe, by and large, a competence for member states. And the recent summit in Gothenburg was exemplative of this. We can propose ideas, but social remains largely a national issue. And also, let's face it, because the social models, everybody says there is a European social model. That's true when you look at it from the United States. You know, Mr. Padoa-Schioppa, he used to say something that I think is very true. He said, well, when we're in Europe, we feel very different from each other. Well, the French, very different from the Spaniards, which are very different from the Germans, from the Swedes, or what have you. Now, when we looked together from Australia, we look very similar. And I think that's very true. So there is a European social model if you look at it from Australia. There is no such thing if you look at it from France or Sweden or Germany or Greece, whatever. And this is part of what makes it difficult to integrate social, because what is meant by social is different from member state to member state. I can tell you, discussions in the Council, each time you touch on the social issue, are just incredible. And it's not bad faith, it's just simply that the concepts are different. People do not mean the same. What is important for a Swede is not necessarily important for a French, and vice versa. So that's the reason why social is and is going to continue to be the challenging part in the ESG, as far as regulation is concerned, at least.
Thanks a lot for these remarks. And I agree with you, it's better to have one priority, so hopefully for the next 5 years, I think FISMA should focus on making finance serve these sustainability goals, and I think stability is still a part of it. So thank you.
Thank you.